Welcome to the TAC Index AI podcast, May 6, 2026, where we blend TAC IP data, reports, and charts with the latest news in all things logistics with a focus on air cargo.
Yeah, we have a lot of ground to cover today.
We really do. So for your deep dive mission today, we are unpacking a massive disconnect. Imagine watching ships desperately navigate military blockades just to keep the lights on.
Right, literally just to keep things functioning.
Yeah, exactly. While the stock market is over there partying like it's the dot-com boom all over again. How is this volatile Middle East conflict rippling through air freight capacity, oil prices, and, your own portfolio?
It really is a split-screen reality right now. You can't look at a single shipping lane or, a barrel of oil without seeing the fingerprints of geopolitics dictating the terms.
Absolutely.
But then digital markets seem, well, entirely detached from it all.
Totally. Let's start with the physical reality, though. Looking at the primary TAC Index May 4 data, we are finally seeing global air freight rates dip a little bit.
Yeah, down negative 1.2% week over week, right?
Right, exactly. And this is after 2 solid months of just surging prices. It's tempting to call this a cool down, but, to me, it's just the pressure cooker letting off a tiny hiss of steam.
Just a little hiss, yeah. The stove is definitely still cranked to high.
For sure. Because even with that slight dip, global rates are still up, like 37.2% year over year. The underlying heat hasn't actually cooled down at all.
No, it really hasn't. We're just seeing a momentary capacity adjustment, and that pressure is warping regional hubs in completely different ways,
Right, like London.
Yeah, if you look at outbound London Heathrow, rates there are up an astounding 107.7% year over year.
Wow, over 100%.
It's massive. Meanwhile, in Asia, outbound Hong Kong drifted lower, perfectly in line with the global average.
But Shanghai was up, right?
Yep, Shanghai gained 4.2% week over week. But going back to that massive 107% spike in London, it's all geography.
Because European carriers are getting hit harder by the Middle Eastern airspace closures.
Exactly. They are disproportionately impacted compared to Asian routes. They're being forced into these massive detours.
Which obviously burns way more fuel.
Drastically increases flight times, and it artificially constricts the capacity of those planes.
And, well, those forced detours bring us right to the fuel keeping those planes in the sky.
It always comes back to fuel.
Always. Air cargo capacity is totally tethered to the crude oil baseline, which has been incredibly volatile lately. But we just saw oil prices actually fall over $2.
Yeah, Brent crude dropping 4% down to $109.87 Sembrel.
Right. And the market is kind of breathing a sigh of relief because that fragile 4-week ceasefire is holding between the U.S. and Iran.
Yeah, it's slightly deflating the risk premium built into oil, even despite those recent strikes on the UAE oil terminal.
See, I'm struggling to square this, though. If the Strait of Hormuz is still effectively blockaded, shouldn't domestic supply chains be freezing up?
You would think so, yeah.
Like, the only way we avoid a total domestic price spiral is if we are somehow breaking our own maritime rules to move foreign oil port to port.
And that is the exact logistical workaround keeping things afloat right now. And just as a quick note for you listening, we are impartially reporting the facts of these policies, not endorsing any political viewpoints.
Right, just looking at the mechanics of it. So what's the workaround?
President Trump has temporarily waived the 1920 Jones Act.
Wait, really? The Jones Act?
Yeah, normally, moving cargo between 2 U.S. ports requires American-built, owned, and crewed ships.
Right, which limits capacity a ton.
Exactly. By waiving it, foreign-flagged vessel ships from places like Singapore and Malta are stepping in to move crude and gasoline directly between U.S. ports.
Oh, wow. So it acts as an emergency release valve.
Precisely. It provides crucial supply flexibility while Trump has paused the military operation to forcibly reopen the Strait. They're basically waiting to see if a diplomatic deal can be signed.
Okay, so physical supply chains are literally relying on emergency maritime waivers just to function. But then you look at the broader economy.
It's a completely different reality.
Totally.
For
You
them.
check your own retirement portfolio, and you're seeing this massive macro divergence.
The physical markets are bleeding. Look at Ireland. Their service sector just contracted for the first time in 5 years.
Simply because of inflation driven by this Middle East conflict.
Strictly because of that, yeah. Physical logistics are absorbing incredible costs right now.
Yet somehow the companies building the infrastructure for artificial intelligence are just cashing in on forward-looking demand.
seemingly ignoring the physical bottlenecks, dragging down traditional sectors entirely.
I mean, the digital economy is absolutely on fire. The Nasdaq just hit record highs.
Yeah, it's wild.
You have Intel soaring 13% in a single day, driven entirely by demand for AI chips.
Yeah, they're even overtaking massive traditional companies like Oracle and Johnson & Johnson in market cap.
Which is crazy, right? And it forces us to ask a really difficult question about the physical foundation of this digital boom.
Right. As physical logistics and energy markets navigate these incredibly fragile blockades, you have to wonder.
Exactly. How long can the digital AI boom actually sustain its momentum if the physical world it relies on to build and transport those chips remains completely gridlocked?
It's something you definitely need to keep an eye on.
Until next time.